we talked about the enormous increase in U.S. oil production, 4 million barrels a day. And the question is, what does that mean? People will recall, maybe, that after World War II, the U.S. was the swing supplier in the global oil market. We were the balancer, right? The Texas Railroad Commission artificially restrained oil production, and they didn't allow the country to produce as much as it can to prevent price spikes, so we could put more oil on the market if we needed to. Over time, consumption went up. We suburbanized for a host of other reasons, and we kept importing more and more oil, and by March 1971, for the first time in history, they lifted the quotas, and they said, go and produce as much as you can. And then 2 years later, the Arab oil embargo happens, and then the OPEC, and most recently, mostly Saudi Arabia, have held that mantle. They have been the places with swing spare capacity, the ability to put more oil on the market, or the willingness to hold oil off the market that they could otherwise have sold. And that's given them a huge amount of leverage in the global oil market. The oil price started to decline last year. People thought that OPEC, again the Saudis, would respond by pulling supply back to prop the price up. And on November of last year, they had a meeting and they said, no, we're not going to do that anymore. We're going to let the price fall. We're going to let the market balance. We're going to let the price, we're really cheap producers. Why should we not sell our oil? We're going to let the price fall, and we're going to let higher cost producers, like some people thought it might be like the US, but maybe like other countries, Canada, Russia, elsewhere, we'll let them cut back production because it doesn't make economic sense. It turns out that whatever people thought the break-even price of U.S. shale oil was a year ago, it's actually much lower than people thought. U.S. oil production is going to continue to grow, not as quickly, but continue to grow, even at lower prices. And that means over time, the market comes into balance with other countries, high-cost producers like some of the ones I mentioned, cutting production. And shale oil is different than conventional oil because it is very responsive. It goes offline really quickly for reasons we can talk about, and it comes back online really quickly. So that means potentially that as the price starts to rebound, the U.S. supply comes back very quickly, and now the U.S. Supply, the economics of U.S. shale are setting a soft floor on the world price rather than OPEC. That's a historic shift. We're going to learn over the next few years if what I just said is true, but that is very plausible, I think. What it means for other countries like, we can talk about each one of these for a while, but Russia, combined with sanctions, the low oil price has meant that the ruble has fallen by half. We've had about $150 billion of capital flight from the country, severe economic pressure on that country. Whether it brings Putin to the negotiating table and to pull back aggressive actions in Ukraine remains to be seen. We see, unfortunately, things going in the opposite direction. And I think countries like Venezuela and Nigeria don't get talked about enough because of what the oil price collapse could mean for real chaos in those countries. The potential, Venezuela was already in an economic downward spiral, and the ability for lost oil revenue to mean that that country really falls into economic collapse. Same with Nigeria, and what the spillover effects would be for Venezuela's support of fuel subsidies and the Petrocaribe program through the Caribbean, or Nigeria's ability to fight Boko Haram and terrorism. There could be a lot of worrisome spillover effects as a result of the oil price.